Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And I'm back here on the Investor Coaching Show. Paul Winkler. Talking money and investing. Okay, so there was an article in Think Advisor. It's written for financial advisors, and the article says this. So this is what the type of stuff that financial advisors are reading. Every once in a while, I like to bring this up to you just to kind of pick on stuff. But anyway, which I like to do. 60-40 portfolio was never dead, says a researcher, Vanguard researcher. Now, we don't have a dog in the fight on mutual fund companies. I'm not a big fan of a lot of the mutual funds that there are a couple of funds that I think are okay that Vanguard has. And like when we're allocating people's 401ks, we might use them. So people are going, hey, you're picking on Vanguard and you had us use that in our 401k. They can be good in some areas as opposed to some of the more active managers in 401ks that we see. So we're known to use them in some certain circumstances. But we don't have a dog in the fight because we don't get paid by mutual fund companies. But anyway, so I see stuff like this and I go, I want you to kind of get what's going on in the investing industry. Because the more you understand this stuff, the less you can get taken advantage of, is the way I put it. It says the allocation has done well by investors over the long term, despite weak performance in 2022, was the point being made here. Historically, a small percentage of stocks have generated most U.S. market returns. And that's the point they were making, 60-40, because it had been talked about for a while now that the 60-40 portfolio is dead. 60% stocks, 40% bonds, which is what is often talked about as a portfolio to take an income from in retirement, is dead. It doesn't work anymore. And I heard lots about that over the past few years. And because, if you look at the research on how much income you can take from a portfolio, there was research going back to the year 1900. So you got a certain amount of money. You're trying to take an income every year from that money that you've accumulated. How do you do it? Well, you got to figure out how much in stocks versus bonds that you own. And the research that was done looked at how much should you own in stocks. And the research said that minimum 50% of your portfolio being in stocks. This is Bill Bengen's research. You can go up to like 70, 75%. So 60% right in the middle. And you can take that income and increase it for inflation every year. And what he did is he looked at 30-year periods. So you're retiring at age 65, you want the money to last at least till 95, let's say. Because most people they're gone by then, right? So, and you want to be able to increase your income every year for inflation because, 30 years ago, you could live on a fraction of what it takes to live right now. I mean, just a couple of years ago, you could live on a fraction of what you need to live on right now. But, so we want to make sure that we have our income keeps going up as time goes on. Well, how much did you have to have in stocks versus bonds? And that's what the research was. And how much income can you take? So you hear the 4% rule. So I got $100,000. For every $100,000 I've got, I can take $4,000. If I have $200,000, I can take $8,000 a year. If I got $400,000, I can take 4% of that, and I can take $16,000 a year, and increase it for inflation each year. So 16,000 one year, maybe 17 the next year, and increase it every single year. So what happened is a lot of the researchers, quote unquote, came out with data that says, the 60-40 portfolio doesn't work anymore. It's dead. Why did they say that? Well, what happened in 2022 is stocks went down. It's a rough year for the stock market. And interest rates went up. And when interest rates went up, longer bonds especially dropped in value. Now, what I've always talked about on this show for well over 20 years is bonds aren't there for return. They are there for stability. Shame on you if you as a mutual fund company invested too much in bonds that were longer-term bonds. That was the problem you ran into, and that's exactly what happened. Is these mutual fund companies, like Vanguard, they had a fund which was a life strategy. I think is moderate growth is the one that they have, which is 60-40. 60% stocks, 40% bonds. Well, I looked at what happened in 2022. No wonder people were coming out and saying, it doesn't work. It didn't work. There was a problem. In the first part of the year, the first 6 months of the year, their bond fund that's in that fund that they invested in went down over 10%. International bonds, about 10%. Why? Because their durations were bad. They had a 6.38 duration, 6.38. In English, what that means, a 1% increase in interest rates drives down your bond prices by over 6%. 7% in the international bond fund. So they were buying the wrong types of bonds. And this is something that I've used, and I've said, hey, 60-40 portfolio worked fine. Why did it work fine on my end, but it didn't work for them? Because our durations were like 2, a fraction of it. And some of the duration on the bonds were less than 1, far less than 1. In fact, some of the bonds actually went up in value when the stock market went down, which is what I've talked about on this show for over 20 years. You got to watch the risks. You can't be investing in bonds with high durations, interest rate risk, and also when they're lending money to companies or governments with one foot on a banana peel and the other in a bankruptcy court or insolvency. You can't be doing that. And that is the problem, is the mutual fund companies, they go out there and so often they will invest money based on, we got the lowest management fee. To heck with how we manage risk. And you look at that same point in time, their total stock market fund went down 21%. 21%. In a year that small value stocks only went down 3%. So that was another problem. They weren't investing, and that was just the first 6 months. For the first 9 months of the year, their total bond market fund went down almost 15%. Their international bond fund went down 13% for the first 9 months of the year, for the first 3 quarters. And you had a 24% negative, 25% negative return for their U.S. fund in a year that ended, as I said, with some areas of the market hardly going down at all. What was the problem? The problem was that they weren't diversified, A, and that they had the wrong types of bonds, B. Other than that, they were great. Recognize when people say, oh, the 60-40 portfolio is dead. And then they come out and say it was never dead. That is like, going, what? Which one do you guys believe? Do you believe it's dead or it doesn't work? Because when you said it was dead last time, what I did is I bailed on it. This is the problem for investors. When you said it was dead before, I bailed on it and I did something different. Now that it came back to some extent because interest rates went down some, now that it came back and I wasn't there when it came back, you're telling me it's not dead anymore. Well, you're giving me the information too little, too late. And he's just, where is the responsibility for this stuff? That's what makes me crazy. And there's just no responsibility for the end investor. Oh, it just makes me nuts. Paul Winkler, Investor Coaching Show. 60-40, fine. The research has been fine. You got to follow the research. Diversify. Keep the durations short. Keep the credit quality high. You can't break the rules and expect that it's going to work out just fine. Hey guys, if you want specific advice for your unique situation, schedule a free 15-minute phone chat with one of our trusted advisors by going to paulwinkler.com/call. We don't sell any products, and our advisors don't make any commissions, so this isn't a sales call. We have a coaching process that helps you understand investing and relax about money. Don't put blind trust in anyone with your financial assets. We want to partner with you in the process so you know what you're doing and why. We manage assets on a fee-only basis, which means that when you do well, we do well, which aligns our interests with yours from the start. We also bring you into the financial planning process that gives you a clear plan so you can find the freedom to pursue your purpose. All our advisors are degreed planners too, with years of experience. So schedule a free 15-minute phone call with an advisor by going to paulwinkler.com/call. All right. I am back on the Investor Coaching Show, Super Talk 99.7 WTN, paulwinkler.com. So I can't remember if I covered this, but there was an article talking about that your credit report and your credit score doesn't matter. I've heard that, people say that and go, yeah, it matters. And there was another article that actually pointed out that I had pulled from some magazine. I can't remember where. I just don't have it with me. But it was talking about that it actually does matter. And it talks about it does matter because it can determine what you pay for insurance. Because insurance companies, if they look at you and they're going, I'm looking at insuring this person, but I have no clue whether this person is a person of character. Sometimes they will look at your credit report. And even an employer may hire you, look at credit report because they want to know if you're a person of character. And typically what they do is, and this may not always be universally the case, you might have something that happens that's just bad luck, or just, something, happens and you're just going, oh man, I end up with a big medical bill, or, I've seen all kinds of stuff over the years where people end up with a bad credit rating. And there's just really nothing they could do about it because circumstances were so bad. And it was just something nobody would have expected happens to them. But, that being the case, an employer or an insurance company is trying to figure out whether you're a person of character. They will often look at your credit report. Why would an insurance company look at that? Well, because let's say if you got homeowners insurance and they're worried that you're going to file claims, that are a little bit fraudulent to try to get money out of them. Well, typically, if you look at somebody's credit report and their credit rating is high, it may give you an idea that the person is of higher character because they pay their bills, and therefore they might not be likely, because they're not in financial straits, they might be likely to not try to defraud the insurance company. So that's why, your credit report and your credit score can still be a really big deal. Well, somebody asked me the question, I was like, well, how do you get a good credit rating? What do you do? And, sometimes I've told people, get a gas credit card because you're not going to buy more in gas than you need to use. But the other thing is that you can do is you can actually go get starter credit cards. That's another thing you can do. Sometimes people will get like student credit cards or store credit cards and just make sure you pay it off every single month. You want to be what's called a deadbeat to the credit card issuer. And you say, what's a deadbeat? What are you talking about, Paul? That was an old thing that I remember Ron Blue, he's a financial guy. He would write about that. And he said, deadbeat is somebody that pays off their credit card every month. But you can get a secured credit card. You put down a certain amount of money. But there are articles out there that you can read about getting, like there's an article about how to get a credit card for the first time. Best credit cards for beginners, trying to make sure that you get credit cards that don't have annual fees. And maybe you won't get any rewards or anything like that or welcome offers, but you can start to build your credit. Just be really careful to make sure to pay off the doggone thing every month. Be a deadbeat in that area because they don't make any money. That's why they call you a deadbeat. They don't make any money off of you. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. You want to learn more about what we do, go to our website, paulwinkler.com. You can watch some of the videos there, and if you're not already a client, you can set up a free initial consultation. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.